Thank you for attending the latest installment of the Options Industry Council's webinar series. My name is Alexander Osinga, and I'm a staff member here at the OIC. I'll be guiding you through today's session, your special introduction to options. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, presented by NASDAQ's Al Brinkman, we'll review step-by-step the different type of options, basic strategies every investor should know, and why options should be considered as part of your portfolio. Al is a veteran exchange executive and is a principal with Brinkman Group with over 20 years of experience in the industry as an equity specialist and an options floor broker. He also serves as a staff instructor for the OIC, and we're excited to have Al to present today's webinar. And now, ladies and gentlemen, Al Brinkman will introduce our topic today, your special introduction to options. Al?
Thank you, Alex, and thank you all for taking some time today to come out and attend the OIC's webinar series presentation on getting started in options, or as I call it, really basic options. And it's going to be that. We're going to outline, we're going to lay out some things you need to know, some terminology that's key to it, and set you up, I hope, to make the next steps. And we're going to talk about those as well. So first things first, the Options Industry Council. Options involve risk. They're not suitable for everything. We have to use a little disclaimer up front on that. Those of you, and I'm going on the assumption here that virtually everybody here is new to options. So when you make that decision to start trading options or look at using options in your portfolio management or your trading, when you open your account with your brokerage firm and get approved for trading options, and they will start you out slowly, I am sure, you're going to get a hold of a document called the Options Disclosure Document, or ODD as we call it. And that document is a good piece to read. It's a good thing to sit down and read and review. It has a lot of good information about terminology and the various types of options that are now available in the space. The Options Industry Council, very quickly, industry resource funded by the Options Clearing Corporation. It is set up to provide investor education just like we're doing right now in a totally free basis. Live seminars, an incredibly powerful website that can get questions answered for you, allow you to practice trading, review different option-based strategies, just a whole plethora of great things. Options Clearing Corporation are running this as the guys who make this whole thing work. It's an equity derivatives clearing corporation, and that's kind of the key element of why options have become so popular, because they do this counterparty clearing. We'll talk about that a little bit as we go through. Okay, so listed options exchanges who support the Options Industry Council, and you can see the 5 primary exchanges listed there. I had the fortunate time in my career to work for NASDAQ, which really Philadelphia Stock Exchange, which was taken over by NASDAQ a few years ago. My entire working career has been spent in the options business. I always like to use this slide real quick because it shows the growth of this, and what it really means when you look at it is seeing how options in their start in 1973 at the CBOE grew and became an accepted product. And a lot of that, not all of it of course, but a lot of it had to do with the options education that OIC put in place to get folks like yourself comfortable with the idea of adding the option product to your investment portfolio, if you will, for something else to use. You can see the exponential growth that options have had into a mainstream investment product. What are our goals for today? Where are we going with this? We'd like to gain an understanding, and we're going to use basic terminology. Like anything else that's out there, options have a language that's all their own. And understanding these terms and getting comfortable with them is obviously the key, because you're comfortable and you can move forward. Mechanics, what they are and how they work. And that's, once again, another one of those, let's get comfortable. If I'm doing this kind of option trade or that kind of option trade, how does the option inside of this, what's the elements of it, if you will? And I really want to talk about, since we're looking at basics, how they can fit into your investing program. What are the risks? There are some. What are the rewards? There are certainly some of those. And where can we use this? Where does it fit across that spectrum of your investment goals and managing that investment portfolio that you have? And then talk about what are your next steps? How do we move this forward from this basic, if we're interested? In order to take these 4 bullet points that we have above and really fit them into the time allotted for our webinar tonight. What we did here at this presentation at the end of it is we've added some appendices that have a little bit more detail on some specific topics. I am not going to be able to, as I mentioned, cover those this evening just because we still don't have the time, but they will give you, and I tried to put the slides in such a way that you'll be able to read through them. So, my first thoughts: you're an investor, you've got a stock portfolio, and you look at your basic mantra in the stock market is, I want to buy low and sell high. So that makes a lot of sense. That's the way the market works. When you buy a stock, it either goes up or it goes down, or it kind of stays the same. Well, here's where the option enters into the trade. As an option investor, you can possibly make a profit in your portfolio when stocks are going up, when they're going down. And the third one is the key element here, where options start to differentiate themselves or make a case for being in the portfolio, if you will, when stocks are going sideways, when the market's in a neutral mode, there's not much movement in the market, you're sitting there watching your stock portfolio, kind of sit there and you say, look, go up or down, but do something. Well, guess what? We can stay engaged in the market even when it's doing that through the use of options. As an option investor, you can also protect gains that you've made. You've got a stock in your portfolio. You've had it for a while. It's got a nice gain. But how do I protect that gain? Because the market can turn around, that individual stock can turn around and come down. I can utilize an option-based strategy for protection. I can manage risk in my portfolio. I can reduce the risk of an exposure to a position or the exposure to an industry, if you will, that's in the news. I can do some option trades that will help me reduce that risk a little bit, take some of it off the table, and back up to a market going sideways. And this particular one, increasing income, works well in that type of market. So we're sitting there, our stocks are not doing much up or down, but we can take that option, we can take several option strategies that are available to us, and we can use it to bring income into our portfolio. So incredibly versatile tool, if you will, that options are. And I kind of like to look at, the analogy, if you will, and we used to use this years ago with the options industry, is the toolbox. It's a tool in your box of investing capabilities. We used a hammer as a designator for that. It might be a little bit heavy, but it gives you the idea of you need to have this tool in the toolbox because there'll be a situation where it fits, where you need that tool to deal with something. But options, no doubt, are complicated and have risks involved in them. So today, let's take some key points, terms, concepts. Second bullet point, we're going to use these options. Well, there's some trade-offs. And I always say there's no free lunch. So we've got to be familiar with or comfortable with the fact that in utilizing options, what are the trade-offs for using the options? For gaining this risk management, for gaining this income, am I giving up something here? What am I trading off? Or what things do I need to understand about how the option works? So my favorite thing, and I can speak from experience here, options trading and working with options requires what I like to call stubby pencil work. Now, in today's world, we don't use pencils too much, we use spreadsheets, but you're going to need to spend some time. You're going to need to study, ask questions. OIC is a tremendous resource. Your broker will be a tremendous resource if you have questions for that. And we're going to have to practice. Like anything else, to get good at something, you're going to need to practice it a few times and get comfortable with how it works and what you're doing and what you can do with it. So options offer options. Your market forecast is the key. Your market research is always going to be the key. You can utilize and be comfortable with and be successful just using basic option strategies. By that I mean buying a call, buying a put option, doing an income strategy such as what is known as the covered call, or as you get more experienced, that you get more comfortable with the options, you can move into what we would call more advanced option strategies. These usually involve utilizing 2 or more options. They have unique risk-reward characteristics that you need to be comfortable with. But options offer you strategies across the board for all market conditions and whatever the underlying forecast for the underlying is, up, down, sideways, whatever it may be. So understanding these, what we call rights and obligations, pricing of options. Where does option pricing come from? How does it, when I look at it, do I know it's a good price, bad price, too much, not enough, whatever it is? We need to be comfortable with the terms that create that price. What happens because option prices don't work the same way as stock prices. Basically, two types of option contracts, calls and puts. Remember that. For an equity option, and that's what we're going to focus in on tonight, there are certainly a multitude of options in various products, from currencies to interest rates to everything else particularly out there, and different styles of options. But tonight we're going to focus just on that basic introduction here. We're going to say there's 100 shares of whatever the underlying stock or the exchange traded fund is that's involved in the option that we are taking the option on. That's what you're taking an option on, 100 shares of the stock or 100 shares of an exchange traded fund. This slide is what I think is a critical core part of options. If you're new to options, this is the slide. If I was going to take one slide out of this presentation and paste it in front of me as I started to move into options, this would be it. Options are contracts, and as such, when you have a contract, you have a right and an obligation. There's two sides to the contract. So in the case of the options, we'll just go, we have the long side. We're buying the option. For the call option, that gives me the right to buy that underlying stock, 100 shares of it, at a price at any time before this option that we're buying expires. It's just like taking an option to a degree, on a house, to buy a house. We put a price in, we have an option to buy it at this price for a period of time. And if we don't do it, the option expires and we need to relook at it. The other long side is the put option. In that case, we're buying the right to sell the underlying stock, 100 shares of it, at a specific price at any time before that particular option expires. Critical element. If we decide to sell or become short a call option, we are taking on the other side of the trade, or the obligation to sell or deliver 100 shares of this particular underlying stock at the agreed upon price, the strike price, at any time before the option goes away. With the put side, we're taking on an obligation to buy it at that agreed upon price, 100 shares of the underlying, at any time before the option expires. When you're looking to trade an option, put an option trade on, whatever it may be one of those more advanced ones that involve two options, or just the one buying calls, buying puts, whatever it may be. Absolutely first thing you need to do is understand and be comfortable with, what right am I doing by getting this, or what obligation am I undertaking by doing this particular trade, and be prepared to do that. Now, critical element here is the buyers are in control. They make the decision on whether someone who sold it has to sell or buy the underlying stock. So a critical piece to this, first piece, look at it, say, we're looking at this trade, what's my right and obligation with it? From that point of view. So I think that's absolutely a critical piece to it. One other thing that I would give you as a word of advice, put options. If you're becoming familiar with and comfortable with the idea of buying the right to sell or taking on the obligation to buy, it takes a minute or two. So the next step is, okay, I've got it, but I'm using a put. Let me take a little extra time. And I like to say, step away from the table, take a deep breath, breathe out, sit down, and be sure that you are comfortable with what you're doing involving a put in particular. They just are a little counterintuitive and can be confusing. And honest to goodness, I still do that to this day. I need to take a second with the puts. I think it was because in the early days we only had calls for a while, and then puts came out, and we were having enough trouble understanding the call option concept, let alone somebody throwing a put at us. Let's take a look at this contract we've talked about. Let's just dissect it down the line. And we'll start from left to right. XYZ, that's the stock. Good old XYZ. The stock is the underlying. That's the 100 shares that somebody can take delivery or make delivery of on that. January, the option expires in this particular month. The last day it trades that you can buy or sell it in the marketplace is usually the third Friday of the month, and the option expires. Decisions on exercising the option are made then. That's the last day that you can do that. Remember, you can do it at any time prior to that, but that's the last chance you get to do that from it. Teaching point I would think here is there's an expiration date on the option. It's like that carton of milk in the fridge. It's got an expiration date. Unlike the milk, they kind of say you can go a couple of days after that, let it go. You can't with this. It expires. Poof, gone. So you need to make some decisions. And we'll talk about trading plans and looking at expiration and kind of thinking about how you want to deal with that in an option strategy as we move through here. 55, that's called the strike price. That's where the stock would change hands, be delivered, made delivery, however it would be, at $55 a share. Doesn't matter whether the stock's $60 a share or whatever, you're going to have to deal with it at 60. It's going to come in at 55, and either that's a good thing, bad thing, we'll see. We'll talk about it. Type of option, in this case, we're calling it a call option. So let's step back real quick. We just have to a call option, XYZ January 55. If I was long this, what would I have the right to do with XYZ before expiration in January? I would have the right to buy it. If I had sold, was the seller of this option, the other side of the trade, I'd have to make delivery of the stock at 55. At any time before January that the buyer of the option said, I want that stock. You'd have to do that. And then the last piece is the premium. This is what you pay to get the option to buy, if you're going long, 100 XYZ at $55 a share any time before the January expiration. If you're the seller of the option, the writer, that's what you take in for taking on the obligation to deliver the stock. You get $2.30. It's 100 shares of stock, or $230. Let's talk a little bit about this exercise assignment scenario. The longs invoke the right. Remember, the buyers have the rights, and the shorts writers fulfill the obligation. They choose to buy the stock at the strike price. They call the stock away from you. The put exercise, they choose to sell the stock. You have it in your portfolio. I can get rid of it, if you will, or put it to someone at this particular price. You're required to sell if you get the assignment, you're required to sell the stock at the strike price. It's called away from you. Put assignment are required to buy the stock, so it's the opposite thing. Down at the bottom, the process is completely managed by the OCC through your brokerage, and I'll just say it's a random process. So it may or may not happen, particularly prior to exercise. But there is a scenario at the expiration of the option, that January 3rd Friday that we mentioned earlier. Any option that has value, that is called in the money, talk about that in more detail as we come up, but it only has to be in the money by 1 cent. It will be automatically exercised. And that's another piece of thinking about how we handle or manage an options trade as we move forward to it. Early exercise is possible. And that's another piece of the planning process that we need to be comfortable with, that this could occur. Exercise style, I've mentioned American style, which are all ETF and stock options traded on American exchanges, alongside can exercise at any time. Buy it today, but technically exercise it by the close of business today type thing. And the short side, conversely, could be assigned. It is a physically delivered option, meaning you get the stock or you have to deliver the stock or go short the stock in your particular account. So the securities are debited and cash is credited on that. The other exercise style to think about that you will see out there is called European style. And that, exercise and assignment can only take place on the expiration Friday. For the most part, the European style exercise assignment occurs in index-related type of options. Why is that? Primary reason is that the reason the Euro exercise was originally set up was that you had a fund manager to give an example, who has a portfolio of stocks, and let's say they're in the semiconductor industry, and they have a section of their portfolio, and an index is created for that. So they want to get that index, hedge that position of their portfolio rather than go out and buy options on each stock. It's easier to do it as an index value if they're correlated, if you will. And the hedge fund manager wants that hedge to last a specific period of time. He or she needs to know that that's the period of time. Well, with the American style, you can get unhedged, if you will, because of the ability for someone to exercise it. This way you know that nobody's going to exercise the sign in this scenario until such day as it expires. Also, because these are primary in the index world, they're called cash settlement, or they're done in a cash settlement. So you get the difference between the in-the-money strike price and a settlement value determined by the index. It's determined on the index rather than get a little chunk or have to deliver a few shares of this and a few shares of that are in the index. That would be pretty difficult and pretty annoying to do, I would think. We're just going to do it as a cash basis because it's made up of multiple stocks. Indexes are great because they allow you to trade broad markets rather than an individual stock. You know, SPY, that sort of thing. You can trade a broad market. You can trade a specific industry group within indexes and stuff. Should you look at indexes, and you certainly should, I'm saying you need to step back a second with those as well and read the specification sheet, read the manual, because some are European, some may not be, and there's some various expiration dates involved in indexes. So keep that in mind. If you're looking, be sure you read the directions. Another set of terms that I think it's important to understand coming in or getting started in options is the difference between two things we call volume and an open interest. Because when you go online to look up options that you're looking at, you'll see these two columns up there before bid offer spread and all the other things that'll follow on behind that. You'll see volume and open interest. And that's kind of like, okay, well, what's that mean? And why is it significant, or why do I need to just take a look at it? Volume, every trade. Two sides to every trade, a buyer and a seller. I buy 100 contracts from you. We've traded 100 contracts. The volume is 100. It's not a cumulative day to day. It's cumulative during the trading day, but it doesn't carry over. So every day we reset the clock to 0 and we see how much trades. The other figure that you'll see is called open interest. These are the number of contracts outstanding. In other words, these are the ones that somebody could exercise. And it gives you the long side. So this many people could exercise and get this much stock in this particular option. It is a cumulative number, and it may rise or fall each day. People close out option positions. People make exercises. They close out the option one way or another, so it can rise and fall as the volume goes. It is calculated at the end of each day and then published, so the open interest is kind of a one-day thing. This is what happened this day, so tomorrow the open interest is this. And at the end of the next day, it's recalculated. Important for a couple of things, but the primary reason is an indicator of liquidity in that underlying option. And liquidity means how's the pricing. Liquidity means that usually the bid offer on the options tends to be a bit narrower if the volume is higher, and the open interest shows that. And I say that usually. There are a few things as you study that you'll understand it may or may not be totally that. It isn't a blanket statement per se, but it does give you an idea that, wow, a lot of this trades, if I get in, I can get out. That type of scenario. Premium. We'll touch on premium. An option buyer pays the premium. It's non-refundable. You pay it up front. The important thing to remember about buying an option is that when you pay that premium, you've just defined your upfront risk. That's the most money you can lose is what you paid for it. So if everything falls apart, that's it. So you define your risk, and that's another one of the very nice things about options is you can, in a lot of cases, get a good look at your risk-reward picture, saying, I paid this much, here's how much I think I can make. Different option strategies that are out there. Seller, you get the premium. You've taken on that obligation. So that's what you said here. For me to take this obligation, you need to pay me this much. There's some numerous factors that we'll get into in a moment that go into that, how much is this much. But regardless of whatever happens, you get to keep the money. You don't have to give back the premium and stuff. You get to keep it from that. As mentioned before, quoted on a per share basis, quoted times 100 shares, $3 means $300, excluding commissions. And that's, let me step back here a second. Everything we do tonight and the examples that we have in the appendices, we're not including brokers' commissions and any assorted fees into numbers that we do. End of the day, they are important. As you open your account, as you do trade analysis and get used to moving forward with these, and you do a trade analysis, even if you're doing a practice trade, you've got to come in and say, well, I would have paid this commission on this trade, and it has to be part of your calculation because it could in some way significantly impact your decision to make this particular trade or not, or to look at a different style trade, that, for example. But commissions, your brokerage firm will be upfront with those. They'll show you what they are. Here's what it's going to cost to do this trade. So even if you decide to practice trade, don't forget, you got to put that in there. Premium, two parts to that premium that we're talking about paying or receiving. One is called intrinsic value, and the other part of it is time value. The option premium is made up of those pieces if there is, in fact, any intrinsic value. Simply put, intrinsic value is what the options in the money amount is. It has to be worth this much. So example, I have a 50 strike price. It allows me to buy or sell the stock at $50 with the option. The stock at this point in time is trading at $55. The baseline is that option has to have at least an intrinsic value of $5, around that $5 number. That has to have a hard count, if you will, number to it, because it's in the money by that much. If it was $4.50, for example, the trade, and it was a $55 stock and a 50 option, I'd buy it for $4.50, 50 stock, $54.50, and exercise, and I'd have the stock, sell the stock at $55. So it would be an arbitrage situation. So doesn't usually occur. And let's just remember intrinsic value. Anything left on the premium for the option that we're buying or selling after it has the intrinsic value out is time value. And keep in mind that it's only when it has that in your money amount, it has intrinsic. It could just be time value for the option. Time value is, remember those trade-off we talked about and earlier? This is starting to show where that comes into play. Time value goes away as the option gets closer to the expiration date, and intuitively it makes perfect sense. If I buy a 3-month option and I pay X number of dollars or whatever to buy it for 3 months, that same option 2 months, with 2 months to go to expiration, is certainly going to be worth less than the 3-month one because it has only 2 months left to go. So that's called time decay. And this piece we're going to touch on again a little further, but this is one of those key elements when we talk about the trade-offs. Options don't last forever. They have a period of time, and the premium has this unnerving little effect of decaying. But think about it from this perspective. If I buy the option, I'm long, I own the option, I paid for it, that time value, as it decays, is working against me. No matter what else happens during the course of the day, whether the stock moves or not, and my option premium goes up or whatever, time value is coming out because I'm a day closer to expiration. Think about it from the other side. I'm the seller. Wait a minute. I sold this option. I took in the money. I want that time decay to go, that option to get cheaper and cheaper and cheaper. I'm sure I'm looking for the thing to go down. Well, the time decay is going to help me with that. So if you're long the option, time decay is something you need to plan for, you need to take a look at in your planning process, be aware of. If you're a seller, clearly you need to be aware of it, but once again, you need to think that, hey, this is working on my side. At the end of the day, or the end of expiration day, the option is going to be worth intrinsic value in the money or nothing. No middle ground here. It's going to be one or the other. Real quick, in the money, terminology have intrinsic, and they may have time value, depending on how much time is left for it before it expires. The at-the-money call and put, no intrinsic value, all other premium is going to be the time that you're buying it out. At-the-money meaning same strike price and the stock price are basically the same. Out of the money, no intrinsic value, all time value. Digress for a second and talk about options and the market itself, the options market. Who makes the prices? Do they just magically appear? Market makers, whatever. At the end of the day, again, at the whole thing comes together, everybody does. Everybody participates, the buyers and the sellers. And they can be you and I as individual investors or institutional investors. And the professional market maker, absolutely. The market maker's there. They're required to, by making markets, make bids and offers on all the options that they trade that are out there. But it comes down to the best bid and best offer or ask is the consensus of all the bids and offers at the marketplace at that particular time. An option ultimately worth what it is. Like anything else, what's the market willing to pay? Basic economics still rules the roost even in the options market. Pricing models, mathematical models that are used, you put inputs in and use and comes out with, well, given all this stuff, the option should be this price. It's a guideline. Supply and demand, buyers and sellers, market dynamics will override these theoretical values produced by a pricing model. So if all of us that are on the webinar tonight decide that we're going to buy this particular call, do you think that the theoretical value that the market has or that somebody put into a computer is going to be the number? No, it's not. It might be for the first couple of us, but as buyers enter the market, prices go up and down, same side of it. So those pricing models, they're helpful. They have a place in the game, there's no question. They establish a trading plan. They don't make your decision for you, or you shouldn't be letting them make the decision for you, let me put it that way. But there's a lot of unforeseen variables. In addition to the factors that we're going to talk about that come into determining option prices that are different than factors that would be for a stock, at the end of the day, again, in addition to those factors, supply and demand is going to override those factors, or will, let's put it that way, will override. Which brings us to the Greeks. And this is the area, or one of the areas, where those of you coming in new to options, everybody takes a deep breath and goes, oh my goodness, if I have to learn all this stuff, this may not be worth it. It's not as formidable as you think. It does require some time, but the logic of these, as you study them, will start to become clear and how they play a role, not only in the pricing, if you will, of where did this price come from or this theoretical value come from, but understanding the dynamic of the option marketplace and how that option price changes relative to the underlying stock price changing or not changing, as we'll get into some of that. The primary Greeks that are in here, delta. How much is the option price going to change versus the stock price? If my stock moves $1, how much can I reasonably expect this option to move? The vega is an option price change versus changing volatility. We'll get into volatility a little bit more. I have more on this stuff in the first Appendix A in more detail. It's important we touch on these and you see them, if you will, and understand that they are there and they are part of the game that you're going to have to work with. Well, we just don't have time to really do a full-blown episode on these. There are full-blown episodes for these on optionseducation.org that you can go and get much more detailed. And again, we have some stuff in the appendix for you. Let me finish this slide and I'll go to a question very quick. Theta, this is the one, the time change. This is where the time to expiration, the time decay, if you will. How much will my option price change as time decay goes? The key element in time decay with options is the fact that time decay accelerates the closer you get to expiration. It starts out at a small number if you're 3 months or 6 months out, and as you start to get to that expiration day, that third Friday of the expiration month, that number, the amount that the option reduces in value for time decay increases. And you will see this once again, it's part of the planning process as you understand the makeups. The other two, gamma, how much will the delta change if the stock price changes? And rho, the change of interest rates. Interest rates, how does that affect things? The three in blue are the ones that you and I as retail traders need to focus on. Yes, you need to understand or at least take a look at gamma and rho, but the ones that are going to be the three working pieces that we're going to work about the most as we do option, become familiar with options and trading are these three. One of the questions was, can I give a short explanation of what an index is? And very quickly, it's a compilation of stocks in a particular grouping, and that could be semiconductor. We had a great semiconductor, or still do, in Philadelphia Semiconductor Index that had the semiconductor industry. When that was really popular, it took all or a lot of the companies in that, and you create an index of all their values. There's a process you go through mathematically to determine which companies come in and how much of an index do they represent. And it's usually based on who's the big guy and moves down through smaller companies. And the big guy tends to be the biggest representative in the index and so on, which goes back to that spec sheet thing that I said very quickly with it. When you're looking at an index, know who's in there and how much they represent, because the bigger one could move the index, has more influence on the index. A lot of indexes, or most that are coming out, new indexes today are what are called equal dollar rated, meaning everybody is an equal piece of the pie, so not one stock versus another has more influence on the overall index. So for that semiconductor index, if you're interested, you see news on it, and instead of sitting there and say, let's analyze 14 different companies that are in the semiconductor index, I can get kind of all of them here. The other advantage, or piece of it, I don't want to say advantage, but the other thing about an index, it spreads the risk across 14 companies rather than one, or however many are in the index. In my example, I used just 14. So you spread the risk out, so it tends to flatten out the risk overall, because you're not trying to pick the one, and geez, I picked one and I put my money in one and that wasn't the one. This way I at least spread it around a little bit. Diversification, if you will. In and out of the money options, and where do they fit in? Why do I care? Out of the money options are going to be your least expensive. All right, they're a percentage. They're going to give you leverage, and options provide leverage. There's no question about it. The answer to the question is leverage is great if it works, and it can be really nasty if it doesn't. They're going to have this lowest delta figure getting into money. So meaning that when the underlying stock moves, that underlying option, or the option that you've got, will move, but it won't move very much because of this delta. It's kind of telling you with the low that they think that this will be not in the money at expiration. At the money options, a little more expensive, greater leverage than an in the money, because you're still paying less to get the coverage, to control the stock, if you will. They're going to be the most actively traded, and they're going to have about a 50-cent delta, meaning if the underlying stock moves up or down a buck, we're going to see that the option premium go up or down 50 cents. All that resets when that happens, keep in mind, but that's kind of to give you the picture. And then the in-the-money option are the most expensive, because you've got that piece of intrinsic value. They have a higher delta. They're going to react more like the stock, and as they get closer, that 50-55 deal, an option is going to have to move like the stock, because it has to maintain that intrinsic value. Have a lot of open interest, probably a lot less volume. The box to the right. Don't confuse as you get started cheaper. I can leverage. I can get a whole bunch of these out of the money options for the same amount of money as I can only get a couple of the in the money options, for example. You need to consider what you're thinking about in the underlying stock. How much is it going to move? That type of thing in a period of time. And the strike price to say. Real quick example. I think the stock's going to move 10% in the next 3 months. Okay, that's a reasonable deal. I look at the out of the money options and say, wow, if I buy a 5% out of the money option, I can buy a whole bunch of them for this number of dollars. I can buy less of the at-the-money options for the same number of dollars, and way less of the in-the-money options for that same number of dollars that I wish to put at risk in this particular trade. However, step back, out-of-the-money option, 5% out, 10% is our prediction, is our forecast for the underlying. We just gave up 5% of the upside for it to get in the money. And remember that low delta means that premium's not going to move as much till it gets to the at-the-money and then steps over the edge, if you will, into the in-the-money. So don't confuse cheaper with better. Look at what do you think this underlying security is going to do over what period of time. Do the math at different strike price levels. All right, it's not intuitive. You got to sit down and do the numbers. If, however, our forecast, for example, was 25% on the upside over that same period of time, now we might want to step back and say, let's do the math on the out-of-the-money option and see where that would end up with that kind of move. That's where the pricing model comes in, by the way. Okay, we did the Greeks and everybody ran for cover. Now you're really going to run for cover when we talk about volatility. On a statistics side, remember those of you that had that most beloved stats class, remember the bell curve. Volatility is the annualized standard deviation of a stock's daily price changes. All right, so we're numb on this already. Think of it as a measure of price fluctuations. Volatility doesn't indicate direction, and this is key when you get your hands around volatility in the market, and they talk about, and it talks about what's the volatility of the underlying and that sort of thing. Higher volatility doesn't tell me that the underlying securities are going up or down. It just tells me that there's more risk in these, that the market is perceiving more risk, and then the volatility, going back to our standard deviations and the bell curve, meaning that the higher it gets, the wider that curve gets. It could be here or it could be here. It could be higher or it could be lower. It's going to be somewhere between this standard deviation off a mean price level. So think of it that way. What it does happen is that volatility increasing in the market in an underlying security means that the call and put prices will rise. Because we don't know whether the stock's going up or down. We know that the potential for it to fluctuate in a wide variation is certainly present. Therefore, we need to take account of that risk so that as volatility increases, option prices start to increase. Conversely, volatility comes in, option prices move in a little bit. An important concept to realize when we're looking at doing different strategies and taking care of different market forecasts. So, after all this, how do we really get started with this? How do we take all these terms and the Greeks and this and that, and we start to push it together into formulating, do options work for me? What can I do with them? Where do I want to look at them? What do we need? You need a forecast. The basis of all we do. What do we think that underlying stock, ETF, index is going to do? Is it going to go up? Or is it going to be down? Or is it going to stay neutral to range bound? Second piece of the puzzle, how much do we think it's going to move? 10%, 25%, 40%. The next thing we need, because we're in the world of options, is a time frame. Do we think this 10% move to the downside will be in the next 14 days, next 30 days, next 60 days, or even further out? Are we looking at a longer term thing? Options are available for longer term periods on that. I always add this last piece in there for my analysis was I got to keep an eye on the broad market. What's going on in the market? What's the trend in the overall market right now? Right now we have a lower volatility market, that type of thing. What are the conditions? And that classic, what's lingering on the horizon? What is just out of sight over the hill there that could influence the marketplace? Just to keep an eye on that from it. Because in your planning, things happen and you need to kind of have the plan for what would happen if things happen, if you will. These three core things, and then that fourth one on the marketplace, are where we get started with it. So what do? What do? They give you the ability to narrow your focus to a set of option strategies that may provide the best risk-reward properties to fit whatever that forecast is. Down 10% as opposed to down 30%, leads you to a different group of strategies that have a great risk reward to take advantage of that movement over the next 60 days or whatever it may be. The diagrams in front of you are P&L diagrams of a variety of option strategies. We've only scratched the surface with this group. So if you had to look at this and say, all right, I got this forecast, geez, which one of these is going to, that's what's going to help the forecast, takes this and makes it a manageable bite-sized chunk. You say, well, these particular strategies are the ones that look like they work best. And then you get the stubby pencil out and you start analyzing those and figuring out where you might want to take a look at utilizing those strategies. So basic analysis that I like to take a look at. You need to understand the transactions and why am I doing this? I want to increase income in my portfolio. I want to take advantage of a forecast for the underlying stock being down 10% sometime in the next 60 days. I understand where I'm going with this, what I want to do. P&L diagram, those charts we saw on the next page, and we'll go into one of those really quickly here. But by doing that P&L diagram and learning how to do those, being comfortable with those, you're going to get three things right away. You're going to see where you break even. Kind of important to say, okay, I need it to go here before I break even. What's my maximum risk on the trade? And where's my profit potential lie? Okay, we have in the appendices just a basic long call, long put to look at. But when we move to those more advanced strategies, what we call spreads, utilizing two or more options, risk and profit potentials come out in a different look. You need to look at those. But doing spread strategies, you really do define very quickly, here's the maximum, here's the profit potential. I got them both in my mind. I can see if they both work. Analysis, don't forget the fees. Go back to the slide, I think it was 13 or whatever. Rights and obligations, understand them. The time frame that I'm looking at fit my forecast. Is my target price within the realm of this strategy in this time frame? What are my exit plans? Where's profit potential? Where's enough is enough if it doesn't go in my way? Where do I have? What are my exit plans? Keeping in mind that not every strategy is going to work every time. Traders in general probably are pretty good at losing money, but they lose little pieces of it. You exit, let your profits run, standard market axiom, but it also means you need to stay within your plan, within yourself, if you will. What's your risk tolerance when you go into a trade? Learn to utilize the Greeks, understand how they impact as that underlying security moves up or down. How are the Greeks going to move? And this is where the models come in. You need to not do it at every price point, every tick. Do a range to give yourself a picture of reasonable expectations of if the stock moves this and volatility changes from this to that. And don't forget time decay, because everything's going to be predicated a little bit on that happening all the time. And knowing this, I can compare strategies. I can improve my decision making as we move along. Real quick, expiration, profit and loss diagrams. We do these at expiration because we know what's going to happen at expiration. It's intrinsic or it's zero. We can't figure out where that option price, because of those factors, will be somewhere in the middle when we don't know where volatility is going to be, that type of thing. But this gives you a picture right away. Describe the opening transaction. Don't write down, hey, I'm going to buy a call. Let's write it all down. I'm going to buy a November 50 call for $2. And then we do the plot. And you can see here, relatively easy to do. This is something that you could practice doing, certainly, with some graph paper, that type of thing. But you can see this is a long call. I'm buying. My profit potential is unlimited. If the stock continues to go up during the life of this call up until November, once we pass break even, in this case 52, because we paid 2, we see where our break even is. At that point in time, we're along for the ride. So instead of paying $5,000 for 100 shares of the stock, the dotted line, we pay $2 to basically kind of control 100 shares of the stock until November. Unique trade-offs, time, and the fact that the option doesn't move like the stock. If that stock goes down 3 points to 47, and we bought the stock, we're down 300. We bought the option. We know where our risk is. It's 200. But we need to have that time frame. Managing the trade begins before, way before, you actually make the trade. You need to have a plan. You need to sit down and work through, what are we trying to do? And this could be across the board. This could be our whole option piece here. We're going to run out of real time real soon. I kind of walk through this thing. Let me go real quick. Know your up or down directional risk. And once an investor makes your trade, once you make that trade, you better stay with it. Diligence, discipline, you don't need to look at it every minute of every day that the market's open. But you can control. You're in control of when I get in and when I get out. Stuff happens. Where to call today, upside and downside. And one of the beauties of options that we're not getting into in a basic, and as you move forward, you'll realize this, is we can make adjustments on the fly with the trade using options, changing options around a little bit. The whole science and art unto itself, and it's something that as you move through, I'm sure you will be moving and taking a look at. In fact, it should be part of the education going forward. Ask yourself, would I still do this at this level? The stock has moved. Would I still put this type of trade on at the stock at this particular level? Do I hold it, close it, or adjust? Decisions. It's easy to do when you're making money dealing with a losing trade. Whole different story. Learn, evaluate, refine. Learn, evaluate, refine. A little bit of homework for you as we wrap it up tonight. I apologize for taking so long. I do like to talk about options. Utilize the resources, books, OIC website, brokers, educational, articles, print, online, classes in person. We offer those around or online. Do some paper trading. Be realistic about it. What you can do through your broker site, you can do some trading, do some realistic stuff. That last thing, be honest, fund the paper account with what you think is as if it were real money. Start with strategies that fit your tolerance and comfort level. And then for that long call, long put, that's just great. And then move on from that. Do that. Crawl, walk, and run later. So I hope this has been a little bit helpful. For it, remember the appendices are there that take some of these things in more detail. Final thoughts from me. Getting rich quick is a poor reason to trade options. Utilizing them in your portfolio to manage risk, gain income, and protect profits, that's certainly better. It's not easy. It takes hard work, diligence, and dedication. But it is a challenge, but it can be incredibly rewarding. Getting comfortable with this really gives you a real comfort level. It's always an opportunity to learn a little bit more about it. But if you feel comfortable with a certain amount of strategies and certain things, certainly that's perfect. Not a bad thing. Keep your emotions in check. Don't get overwrought. Stay focused on your trading plan that you worked out. My last thing I'm going to go over, and probably my last thing is as you start this, even if you're paper trading, keep a log. Keep a journal. Why did I do this? Go back to those kind of reasonings that we taught about. Why did I put this trade on? What was my forecast at the time? What was the market at the time? What happened? And what did I do? How did I react to this? Did I, run around screaming, I'll never trade options again? Or did I step back and say, all right, here's what happened. Here's what we can do. And I need to learn more about this or that. But keep that journal as detailed as you like. I really wouldn't get too wrapped around the axles in general, but what it finds and what I found from doing the same thing was, just like in football, when the opposing coach looks at the film of the other team, what do they see? Tendencies. And you'll be surprised. All of a sudden you'll see tendencies, good, bad, or indifferent. But you can work on those. So keeping that journal kind of allows you to focus on a broad range rather than just worried about the last trade you did from that. So with that, Alex, I think I've talked. I don't know if there's any more questions. We virtually don't have any time. I apologize for taking that time. I do know the OIC will work with you on the questions that you may have put in
thank you, Al.
on this. So again, thank you.
I know, as you mentioned, we're running a little low on time, but we appreciate your time and insights for today's presentation. I hope this has served as a foundation for our listeners to continue their education about options. And ladies and gentlemen, thank you for your time today. While we weren't able to get to all your questions, like Al said, we have our investor services desk ready to help. Feel free to reach out to them at options@theocc.com. Again, that's options with an S at theocc.com. For further education, please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. With that, finally, be sure to follow us on social media, like our Facebook page, follow us on Twitter to stay current with OIC's latest offerings. Thank you again for attending, and we hope to see you again next week.